The tax bill that we've enacted is a very complicated piece of legislation with very large cross-cutting gross flows in terms of the effects on revenue and potentially the effects on prices that consumers and firms are going to face. Right? A lot of relative prices get touched by this bill. The most important direction of reform is on the corporate side. And of course, the headline component there is the decline in the corporate rate from 35 to 21%. That, of course, features immediately in, you all take your Hall-Jorgensen cost of capital formula and begin to change tau. And that, of course, is one of the natural mechanisms by which this bill is likely to have important consequences. But there are other significant pieces, even on the business side, right? There's this element around pass-through businesses. These are sort of, partnerships and other businesses which are not set up as C corporations. For those businesses, there's a 20% deduction for business income, which means their top rate potentially falls by 0.2 times what it would have been previously. Not all the way to the 21% typically for the business C corp rate, but it's a reduction. There are changes in expensing. There's bonus depreciation, which is enacted. It goes from 50% to 100% of capital for a 5-year period. So that's an expansion basically on the investment allowances front. But then, as with many provisions in this bill, that begins to phase out. So 2023 is the last year when that provision is fully in effect, and at 20% a year over 5 years, the bonus depreciation is revoked essentially, so that by 2028 we're in a very different regime. And I think the speakers will probably address some of the dynamics associated with these temporary provisions. There's also a limit on interest deductions for corporations. 30% of earnings before interest, taxes, depreciation, and amortization for the next few years, and then it becomes more stringent. It becomes 30% of EBIT in the out years. So that's another important provision. And again, if you go back to your cost of capital formula, something which changes the deductibility of interest has a consequence for the cost of funds and then what the cost of capital is going to look like. There are provisions, and these are even more complicated than the ones I've just described, that change the international tax avoidance incentives for corporations, put in place a global minimum tax, and those are provisions which potentially could have quite significant impact on the way firms allocate their income and maybe even their activities across the globe. On the individual side, the changes are frankly more modest in terms of at least the ability to describe them. There's reductions in top rate, the top rate from 39.6 to 37. There's some scaling back of marginal rates throughout the distribution. And then there's a number of limitations on various kinds of deductions. Those come in two forms. One is actually limits, like the elimination of the state and local tax deduction, which has been a lightning rod for discussion. And that, of course, raises the cost of living in a high tax state like New York or California or Massachusetts. It also changes the cost of revenue raising for the states in those places. There are also substantial increases in the standard deduction, and that, in some sense, through a different channel, it takes a lot of people who were previously itemizers off the rolls of itemizers, and it changes the marginal prices for a lot of things that they do, like mortgage interest deduction or charitable giving, even things that remain deductible going forward. And then there's some large transfers that are more or less, they're not marginal changes like the child tax credit, where there's a very big expansion of the child tax credit for individuals. That transfers a lot of resources to households with children, but it doesn't have at least a lot of traditional marginal effects. There may be some fertility effects down the road, but those things certainly will take a while to develop. So the key is that there's lots going on in this bill. There are long-run effects, there are short-term macro effects, and I'm hoping that our three panelists today will try to give us a sense of what we have learned so far and what they expect to see as the macro effects of this bill play out. So, Kent, we're going to start with you.
Thanks a lot. And I was asked to just focus on a couple facts that we can, eventually bring to data. And then one of the takeaways will be that there's, as Jim just pointed out, there's a lot going on in this bill, some pros, some cons in terms of economic growth. So I'll try to show you that those effects. In particular, some pro-growth stuff are reductions in effective tax rates, but at the same time, those are temporary. So whenever we do macro analysis, so this is a very high-level sketch of the Penn-Wharton budget model, and our macro analysis really, because we ultimately are going to feed this this into a non-recording overlap in generations model, it really starts with the micro, getting the micro foundations. If you want to have a good macro analysis that is actually very consistent with the bill itself, the actual structure, not something that's stylized, you kind of have to get the micro side right. And so we start with a micro simulation that does all sorts of different kind of rules of education and so forth. And some of these rules are estimated simply a basic Markov transition matrices from the data. And, but some of them, like big decisions like marriage, divorce, and so forth, we actually have a structural estimation from a dynamic programming problem of people getting married, they have kids, and so forth, as part of a dynamic programming problem. And then we go back in date and time and try to estimate how well does the model fit. And so this shows the historic fit, and then we project forward. So this is like education. I'll just show you a couple of these things. Disability, both historic in terms of testing the functional forms, family composition, again, the historic, and then the right-hand side then goes out into the future, race composition, lots of other things that are in the model. And so then that feeds into a tax model, and the tax model is a model that's fully integrated on the payroll tax, individual, corporate, international. And we do, there's a lot of modules associated with this that are based on the elasticities from the literature, things like how much income shifting that's going to happen. This is a bill because of the sunset provisions due to the Bird rule. There's going to be a lot of shifting incentives of income between years. There's also lots of reclassification that will happen, lots of incentive for people to reclassify their income. In theory, we should all not be W-2 workers of our universities anymore. We should become independent contractors of our universities. And then on top of that, figure out how to split that company into a software provider company and a service company and things like that. And so there's lots of those, and then how you realize your gains, and then the international shifts as well. And so this part then produces tax functions that then feed into our dynamic model. So our dynamic model, but before getting there, let's understand what the current law is actually doing. And that is, the first line is showing effective tax rates across all industries. If you're interested, I have an appendix to this deck that shows it broken down by industry. Effective tax rates are, we're starting to realize, that are not always the best way to kind of look at things. It's sometimes better to be more explicit. But if we were to boil it down, with the current law, under current law, the effective tax rates across all C Corps is about 21%. Why is it less than 35%, the statutory rate? Because there's already depreciation faster than economic depreciation in the current law. There's some interest deductibility and so forth. And you can see what the current law, by current law we mean before the Tax Act, how that was going to change over time. Notice what the Tax Act does. It reduces the effective tax rate from 21% to 9%. But notice over the next 10 years, the effective tax rate returns most of the way to current law. What's happening there is that one way that the biggest way that you get a reduction in effective tax rates is not just through reducing rates. It's actually through moving to full expensing for a temporary amount of period. In fact, once you move to high expensing, the rate really doesn't matter very much unless you have monopolistic rents and things like that. And so what happens is that in this tax law, they had to make expensing cheap. It's normally $2 trillion over 10 years. They got it down to less than $100 billion. And how you do it is you just make it really cheap by only having it for the first 5 years, and then you turn it off. The problem is, under current law, lots of that was already going to be depreciated over the 10-year window. So all you're really doing is shifting that depreciation allowances from most of the capital would have been depreciated over 10 years, not all of it, but a lot of it would have. You're just shifting that to today. And because in Washington they don't do present value, they just add up cash flows. On the 10-year cost, it's actually pretty small. And so you're essentially just borrowing against later in the budget window. And so it's not a big impact. Now, over time, again, the effective tax rate still is going to be lower than our current law. And so our static estimates that we feed into the dynamic model, and this is kind of important, is that we actually are more expensive than what the official score that came out of the joint, the JCT, the Joint Committee on Taxation, about $500 billion more than what they estimated in terms of the conventional dynamics revenue losses. And that is a lot because of our modeling of reclassification and shifting and so forth. We just had essentially a different view on that. CBO just released this week their estimates, and they're about 400 billion and change above JCT. So we're very much more in agreement with CBO's view. And because the model that we're going to feed this into is non-recording, this actually matters a lot in terms of the debt feedback effects. So we feed this into a dynamic OLG model. We won't go into a lot of detail because you've seen these models before, but it has a representative firm. There's no aggregate risk because of the curse of dimensionality associated with aggregate risk. For sake of argument, convex adjustment costs are turned off, and the reason, we made a fair amount of pro-growth assumptions that households are heterogeneous. They face idiosyncratic wages and mortality risk. The taxes are paid at the household level, but we distinguish between C Corp and pass-throughs. The model itself captures the income distribution pretty well. It becomes a big issue for the top tail. The wealth distribution, okay, it could always be better. And it has Keynesian effects just endogenously through the fact that you have there's a borrowing constraint in these models that's quite naturally because of the natural borrowing limit. A lot of poorer households cannot actually borrow against the future Social Security benefits and so forth. The Keynesian effects really didn't matter that much in this case. And we actually turned off labor frictions like market search and so forth. And so some of the big assumptions here is what's called the closure rule. There's always these secret, big assumptions in these models. One of them is the closure rule. Debt is exploding under even current law, even before this tax change. And so transversality condition, that doesn't exist in DC. So the question is, what do you do? And so we assume in year 2040, whatever the debt output ratio is at that point, we're going to stabilize it by cutting wasteful government spending that enters anybody's utility function. Very much pro-growth optimistic there because nobody values it. It's not, we're not increasing taxes. And also 40% of all new debts paid by foreigners. Why is that? Why do we make these pro-growth assumptions? If you remember the debate, the whole debate was this whole thing was going to pay for itself. And so what we find is our growth rates on an annual basis that are not that big. And in particular, you can look at things like GDP, labor services, and so forth. But for the most part, not huge growth effects. There is one of the key assumptions, because there's no aggregate risk in this model, prices are perfectly forecastable. How do you pick the interest rate in these models? Is it the risk-free rate? Because there's no risk in the prices in the model, or to the marginal product capital. We can talk about that to the side, but that's an ongoing kind of debate of how you match a model that has lower dimensionality with actual data that's much higher dimension. The true model has aggregate risk. But there's some differences there, but still not so big. Lots of the jump is in GDP is in fact in the short run. Foreign capital flows come in and so forth. You say, well, this seems pretty unrealistic. Again, pro-growth. Even pro-growth model shows not huge growth effects. And why do so much foreign capital come in? Because we turned off lots of the adjustment costs and so forth. And so even with a big flow of foreign capital, we can show other slides, you're still not going to get massive increases. This thing is going to be very far from paying for itself. And there's other background stuff going on. The discussions about trade war and so forth. The irony about this is that trade wars go in the exact opposite direction of tax reform. The whole selling point of tax reform, this thing would pay for itself because all this foreign capital will come in. A trade war, of course, shuts down foreign capital. And so let's look at hypothetically that suppose there's an all-out trade war. Even without the Tax Reform Act at all, the current baseline is exploding debt. And so in our dynamic model, foreign capital flows are really important because that helps mitigate some of the crowding out effects that debt has on private capital formation. If you start having a big trade war, then lots of that debt now has to be financed by U.S. households. The crowding out effect is much bigger. And so basically, if we went to an all-out trade war, it would more than wipe out all the gains over the next 10 years from tax reform, and it would actually by almost 4 times wipe out all the gains gains in the long run as well from the tax cuts. And so even on a dynamic basis, our losses are between 1.7 to $2 trillion, not so far different than CBOs. So another way of saying it, if you cared about this debate at all, we don't believe that the law was consistent with what's called the Byrd Rule, and in particular, it's going to cost a lot more than the official estimates had suggested. And if anything, I actually think we're probably even optimistic. We're the pessimistic guys out there. If anything, we're probably optimistic in terms of the revenue losses than the debt effects, because there's other things. Even though we modeled all this reclassification and shifting internationally and so forth, after the Tax Act was passed, we talked to more tax lawyers. They told us all the ways they're going to game this thing on top of the things that we thought about. And you even see this right now with the state and local tax deduction that's capped at $10,000. States are going to figure out how to whittle around that, whether it's a charitable contribution. We'll see how that satisfies a court test. But simply shifting over time the taxes paid from households to the employer. If you do that slowly over time, you can get away with that. That's not going to be under the $10,000 cap anymore. So there's all these ways that, if anything, we're probably, even though we're supposedly the pessimistic guys, if anything, we're probably optimistic. And so, by the way, if you extend the Tax Cuts and Jobs Act on the individual side, we just released these yesterday, lots of the provisions on the individual side sunset at the end of year 2025. It actually now produces a negative dynamic score. You get no positive dynamic effects because on the individual side, you're given so much of the gains are inframarginal, like the child tax credit and things like that. Outside of endogenous fertility, those are mainly inframarginal, but they have debt effects. And so we actually get negative dynamic scores, where the static score is now cheaper than the dynamic score. So the bottom line of all this is that I think, depending on your view of trade wars and things like that, it's going to be hard to tease out exact economic effects of this for a while from the Tax Act. And then, but on the other hand, if we are in fact wrong that the revenue losses are even bigger than what we suggest, and even the economic effects are going to even be more muted than what I showed you here.
Thank you for inviting me to Marty and Jonathan, and thanks, Jim. And I'm delighted to be up here with Ken and Mark, whose work we've learned a lot from at CBO. All right, so I am not going to talk very much or at all about what the Tax Act did. Jim covered that very well. Instead, I'm going to focus on how we estimated that the changes from the Tax Act would affect the economy. So first, we thought about how it would affect potential output. We actually, as you can see from this figure, this is plotting the percentage effect on the level of potential. The effects were not constant over time. They peak at almost 1% in about 2023, 2024, but the average effect is 0.7% over the whole 11 years. So our projections go out to 2028 this time around. Those come from effects mostly on investment and labor supply. So effects on investment, we put the different channels into 3 different buckets: effects on incentives, economic activity, and crowding out. The effects on incentives, those are the usual effects, the user cost of capital. We also thought about how changes from the Tax Act would change incentives to invest in the United States instead of investing abroad. Changes in economic activity have 2 things. It's the change in demand for goods and services. There's a big stimulus effect here, putting money in the hands of households. And to some degree, well, that's largely the effect here. And so when those households show up and want additional goods and services from firms, they, in response, increase their investment. We also put into this bucket changes in the supply of labor. So more workers show up and want jobs, some fraction of them become employed, and so firms, in turn, increase investment to outfit them with capital. Looking at it more, I think we possibly could have put that in incentives, but nonetheless, we called it economic activity. And then crowding out, this is increases in federal borrowing that reduces resources available for private investment. So roughly speaking, what you should think of when you look at something like these effects on potential output that I showed, what we have in mind here is basically a Cobb-Douglas production function. We're thinking about how investment changes, how labor supply changes, and we're going to put those together. We thought, so here I'm plotting how incentives, economic activity, and crowding out have all mattered in isolation. And you can see that the biggest positive effects come from changes in incentives. Those wane over time. As Jim talked about, there are various provisions that are sunsetting in the bill. Changes in economic activity are also positive throughout. Crowding out is negative throughout, but for the same reason that a bunch of those provisions are sunsetting, the negative effects of crowding out are getting smaller over time. And then if you look at like where we are for the changes of incentives out in 2027, 2028, what's really showing through there is just the change in the user cost of capital from the lower statutory rates on capital income. That's really the most important thing that's left at the end of the day. We had to think hard about how all of these different provisions would affect investment in different kinds of capital. So here I'm showing equipment, non-residential structures, and intellectual property products. Each tick going up and down has all sorts of interesting things behind it. I won't have time to get into much of it, but for example, notice that we actually estimate that the Tax Act has negative effects on incentives to invest in intellectual property after 2021. And the effects on investment in residential structures are negative throughout. Okay, so the effects on the potential labor supply. This is through largely the effects in the reductions in the marginal tax rates on labor income. We have an estimated boost to the potential labor force participation rate, as well as average hours worked, to get a total effect on potential hours of 0.6%. We had to think about how these intensive and extensive margins would be affected differently, although in our parsing, there's a lot of uncertainty around that, but of course, it doesn't matter so much how we separated it out for the total effects on potential labor supply. We also estimated a small effect on measured TFP, mostly from some of the complicated profit shifting effects. It's small. I really only mention it here because it was really hard. Okay, so as I mentioned, we put a lot of money in the hands of households, and to some degree, some of the increases in investment don't flow one for one through increases in potential right away. So we estimate that real GDP is boosted more than potential in the early years. In the later years, that relationship's a bit reversed. This is because the increase in marginal tax rates on labor income that are under current law in 2026, we estimate that change in law will come as a surprise to most households, and in fact will come as a surprise to monetary policymakers. And so you'll get a small decrease in aggregate demand and a small negative effect on the output gap in those years. So if you can imagine what the difference between these two lines looks like in terms of its effect on the output gap, we put it here on top of all of the other things that we think were creating an output gap over the projection. And I partly do this to show you that, particularly in 2019 and in 2020, for a lot of other reasons, in part because of the spending legislation that was recently passed, we estimate that there will be a pretty sizable positive output gap over the near term. And what we think the Tax Act is doing is increasing the positiveness of that output gap in those years. All right, so now you have an increase in aggregate demand that's having some short-term stimulus effects on the labor market. We think that that's going to lower the unemployment rate by 0.1 percentage point, increase the participation rate, increase the number of hours worked. So those effects are mainly focused on 2018 to 2022. But if I take those together and I add them to the effects on potential labor supply that come into play through the entire 11-year period, if I put those together, we estimate that the Tax Act boosts non-farm payroll employment by an average of 1.1 million workers on average over the 11-year period. The increase in aggregate demand, that bigger output gap, we think will create some inflationary pressures. They're not terribly large, and so in fact here we've in fact plotted the effect on the price level. They're not terribly large, first because we estimate that the Phillips curve is pretty flat, but also because there are some effects from the Tax Act that we think are going to dampen import prices. But nonetheless, with greater inflationary pressures and a tighter labor market, we think that short-term interest rates will respond, monetary policymakers will try to lean against this greater aggregate demand. That will have a sizable effect on particularly the 3-month Treasury bill. The 10-year Treasury note rate its response is a little more muted because it's more forward-looking. These interest rates are also higher because of the crowding out effect. So as the federal borrowing increases and that competes for funds, that's going to boost interest rates. Particularly long-term rates are also getting buffeted around from some other complicated factors. For example, the Tax Act is going to do what's called deemed repatriation. There was a whole bunch of money being kept in foreign bank accounts that will now be deemed repatriated, and we estimate that a big chunk of that, what firms will do is they will sell treasuries that they were holding with that money, and at the same time they will reduce their corporate borrowing. That will shrink the spread between risk-free rates and risky rates, and so it's going to boost the 10-year Treasury note rate a little bit. We also think that long-term treasuries will become slightly less valuable as a hedge against unexpectedly low inflation. So that also boosts long-term treasury rates a little bit. Okay, so as you can imagine, it's really important to us to think about what the feedback on the budget is. To do that, we really need to think about what happens to taxable income. Taxable income moves not too differently from the way we think GDP is affected. Real GDP actually, coincidentally, like potential, we estimate is up 0.7% on average over the 11 years. Real GNP is up less by 0.4%. So the gap between those two is because of what we estimate is happening to net international income. So net international income is estimated to be dampened by the Tax Act. This won't surprise you, but just to walk through it really fast, we have a big increase in borrowing from abroad. We also similarly have a big increase in foreign investment in the U.S., and that alongside higher rates of return in the U.S. lead to reductions in net international income. So we have notably smaller effects on GNP than GDP. All right, so turning to the effects on the budget, I'm going to focus on that middle bank, which is the feedback effects from these macroeconomic effects I've just talked about. On net, we think that the macroeconomic effects reduce the cost of the Tax Act, the negative effects on the deficit, by $461 billion. There's some direct effects, mostly on revenue, that reduce the deficit by 571. Debt service costs are higher. They'd be lower if it were just because of the reduction in federal borrowing from these positive effects on the economy, but interest rates are higher and that swamps. Okay, so all in, we estimate that the Tax Act increased our projection of the deficit through 2028 by about $1.9 trillion. All right, uncertainty, I'm betting I'm out of time, but the sources of uncertainty in this analysis were immense. And I was also going to use this in the next slide to back in a little bit to a very quick discussion of how we approached this analysis. So there are many parameters underlying all of this analysis on how we think that investment responds to incentives, how we think labor supply responds to incentives, et cetera. All of those parameters have enormous uncertainty around them. We had to think about what people expected with regards to changes in fiscal policy under current law. This was explicitly an estimation of what we thought the Tax Act would do to the economy under current law. So current law, as it's written, as it comes to pass. That didn't mean that we had to assume that everybody expects current law. So that meant that we had to grapple with what do people expect and how does that matter. All of the analysis of how profit shifting will be affected by the Tax Act is subject to enormous uncertainty, but has less of an effect on economic activity. That was mostly about measurement. Finally, how it will be implemented by the Treasury and the IRS, subject to enormous uncertainty, foreign countries' response, states' dynamic responses, and then how all of these estimates and changes in economic activity, how big the effects on activity will be over the next few years, and then how investors respond to those, also, of course, very uncertain.
My view is that the tax legislation is a very expensive tax cut for high-income households and does very little to support economic growth in the long run. So I think it's pretty consistent with Kent's results and Wendy's results. Just to give you a sense of the numbers, this shows the impact on GDP growth using our model of the global economy, 64 countries, very similar in spirit to, it's a structural model in my view. I define it as a structural model, very similar in spirit to the Federal Reserve's model, the FERBUS model. I think probably similar to what Wendy uses at CBO, very kind of a traditional structural model. Keynesian in the short run, more classical in the long run. And here I've decomposed the GDP growth impacts from 2018 through 2027 into the demand side effects and the supply side effects of potential growth. The line is the sum of the two to kind of give you a sense of things. So near term, this year, next year, we get juice, a lot of fiscal stimulus. If you actually do the arithmetic, the tax cuts this year are about $140 billion. Next year, an additional $140 billion. That's roughly 0.7% of GDP. You can see that the actual impact on GDP in our model is lower. That goes out to the crowding out effects that that Wendy and Kent talked about. There's a lot of moving parts here, so the demand side effects quickly go from positive to negative, and ultimately are big negative because this is under the assumption that everything in law happens, that these tax cuts expire, which is a big point of contention. If you talk to the proponents of the tax legislation, they have a political economy argument that once we get out there in a decade from now and policymakers are tasked with trying to figure out what to do with expiring tax cuts, they will extend them. And that is part of the narrative around the support for the benefits of this. You do see supply side benefits. I do think potential growth is lifted. The model that we're using, that I have, accounts for both the effects, cost of capital effects on investment, but it also accounts for location effects. So one of the other arguments proponents of the tax legislation give is that this makes the U.S. just look more attractive as a location compared to other parts of the world. And I think there's some validity to that. I mean, I think it's true, and we pick that up in our direct investment equations that are in the model. I don't think these are large effects. I think they play out over long periods of time, and a lot depends on what you assume about what the rest of the world is going to do in response. I mean, I was in Dublin not too long after the tax law, and of course, they're all just trying to figure out ways to mitigate the effects by changing their tax law to offset all of this. So, this is not a static thing. It's a lot of moving parts. But nonetheless, I do think there's some benefits there. So short run, juice, not as much juice as you might think because of, fiscal stimulus on top of a full employment economy. You're just not going to get as much juice. The Fed's going to respond and offset some of this. But in the long run, really no benefit, significant benefit. This is just to illustrate the long run effects. This is the impact on a number of different economic variables in 2018 and then in the long run. And you can see long run growth is lifted by 5 basis points, something like that in the long run, which is, I think, pretty similar to other estimates. Sounds a little higher than Kent's estimate. I think it's very similar to what Furman and Barrow came up with in their analysis. So it's, very, very consistent with that. No employment effects in the long run. I mean, that's, I don't see this having any impacts on labor supply long run, and so no real impacts on the labor market. Interest rates are higher because of the higher debt load. Good rule of thumb, it works pretty well. An increase in the debt to GDP ratio of 1 percentage point translates into about 3-4 basis points on the 10-year Treasury yield. That's very consistent with our experience with quantitative easing. If you go take a look at the Fed research on QE effects on interest rates, very consistent with that, and that's built into the model. So that underlies the interest rate effects. But, in my view, this is just a very costly tax cut to go nowhere. Let me now walk through some of the reasons why I think the effects are small, both near term and long term. In the near term, I think there's already pretty strong evidence that there are crowding out effects. This is the 10-year Treasury yield, daily data. Last data point was a week ago today, last Friday. You can see when the tax law was signed into law. That was, I believe, December 22nd of last year, and a pretty substantive increase in 10-year yields after that. If you kind of decompose that increase, about half the increase is changes in expectations for the real funds rate target, so the view that the Federal Reserve is going to respond and raise rates more quickly, normalize policy more quickly. So for the 40 basis points, 20 is that. 10 basis points is inflation expectations, and 10 basis points is the term premia. So some of these crowding out effects are already getting embedded. I'll have to say, it's still early days and a lot of script to be written here, but I haven't observed any significant, other than what's happening in the bond market. And the other big effect in the bond market is LIBOR, because we are seeing, the one thing we are seeing in result of the tax law is repatriation. Moody's, for example, big multinational, we have a lot of cash overseas, repatriating. So that is affecting short-term funding markets. That's showing up in LIBOR, so LIBOR spreads have gapped out. Now that's temporary, it's technical, but it is somewhat disruptive. I mean, there's $3.5 trillion in contracts outstanding based on LIBOR, so that's having an impact, or some impact. But other than that, I just don't see it. I don't see it at least not yet. It's early again. You don't see it in orders for durable goods. You don't see it in consumer spending and retail sales. So I'm expecting it. There's a lot of moving parts here. Hard to distinguish things, but it's so far not much of an impact. But I think again we'll have to see. And I think the multipliers here are pretty small. These are our estimates of the range of multipliers across different types of fiscal policy, discretionary fiscal policy around tax cuts and various types of government spending. And you can see, this was really a tax cut for on the corporate side. So the multipliers are really very, very small, and for high-income households. This also mitigates the short-term impact from this. Really not much of, if you're designing this to stimulate the economy, this is near-term, this isn't what you would do. That would be the 2009 Recovery Act. That would be more consistent with what you do. In terms of the other key effect that the tax law will have that has economic implications, macroeconomic implications, is on wealth, on stock wealth and on housing wealth. And there they work to offset each other. With regard to stocks, just the simple arithmetic would suggest that it should lift stock prices, and initially it did. So if you go back, through January into February, we saw the S&P 500 rise by exactly the amount that would be anticipated by this simple calculation. So we went from a 35% tax rate to a 21%. That should add 12, 13% to after-tax earnings. So if you apply the same price-earnings multiple, that's what we got at the peak of the equity market back sometime in January, February. Of course, a lot has happened since then. The rising rates are starting to catch up, and also trade wars and Trump, and we're right back down. The equity market is no higher, but I do think we did see some benefit from the tax law in corporate profits. One other thing I will say about that, though, real life, is because I'm on the board of MGIC, which is the nation's largest mortgage insurer. We just cut premiums on our MI, right? And what we did is we just completely gave away all of the tax benefit. So that's already happening. If you're in a competitive market, this gets competed away pretty rapidly. And in the MI business, it's gone. It's already gone, just as an example. But this benefit to the equity market is offset by what it means for house prices. And this is our guesstimate of the house price effects across county. So, we have this big global model. We take that down to states, metropolitan areas, counties, and we do this globally. So we do subnational, globally. I can tell you what's going on in provinces in Canada and states in Mexico, that kind of thing. And I'm sure you're all looking at your home right now. Just to clarify, I'm not saying that house prices are going to decline. This is the difference between house prices in a world with no tax legislation and one with. And this is the peak impact. And it accounts for, there's lots of different channels here, but I'll mention three quickly. One, higher interest rates, right? We have higher mortgage rates. Two, there's economic effects because you've now made this part of the world less competitive vis-a-vis Texas and Florida, and that has location decision effects in the regional models that we have, just like we have in the global model. And three, just the simple accounting here. The New York Fed had a really good blog yesterday that kind of went through the accounting. And the idea is the value of the deductions for housing are now lower. And it's very, people say, well, how does that work? The intuition is very simple. I mean, I can attest to this personally. So when I wanted to go buy my first home, I went to a realtor. The realtor sat down, calculated exactly how much house I could afford after tax. Say it was $250K. Then took me to see, with my kids and wife, a $350K home. And, there's no way you're going to buy anything less than $250K after your kid, picked out their bedroom in the $350K home. So, all of that tax benefit, and I learned my lesson because when I went to buy a car, I didn't take my kids. Yeah. When you start your own company and you're living on your credit card, this is all very important. So I ended up with a Honda Pilot for my first car, not the Volvo. It gets immediately capitalized in the price. So you take it away, and I'm not arguing. I don't think these tax deductions for housing are silliness. I mean, it doesn't lift home ownership at all. It's just a very expensive way to help high-income households, wealthy households. But there is a cost from getting from here to there, and this is the cost. So anyone want to guess which county suffers the most? That's a good guess, but wrong. Yeah. Yeah, everyone says Westchester, and you're probably pretty close to right. I just do it to tease. Pardon me? No. Yeah. Fairfield's a good guess. Essex County, New Jersey. Yeah. It's all very close, though. Here's the other point. The wealth effects on stock in our model on stocks, it's actually a little bit lower than on housing. The housing wealth effects are a little bit larger. But if you kind of do the arithmetic, it all kind of washes out. So there's very little net impact on wealth and therefore on the wealth effects. So short run, it's kind of silly policy. You're throwing raw fiscal stimulus on a full employment economy. Okay, you get 3% growth, get a headline for a year or two, but that's all you're going to get. You're going to get higher interest rates. And by the way, on the other side of that, in 2020, there is a void, and that's where the next inflection. By the way, I can tell you when the next recession is going to be, if you want to know.
Bob Hall, the business cycle.
Yeah. Finally, on the just turning the long run, and then I'll stop. I also think the effects on the long run are pretty small, and I'm just going to talk about something that I'm not really picking up in the model, but I think is important to recognize. I don't think the cost of capital or the availability of credit and cash is a binding constraint on investment. It really has not been. There's lots of ways to calculate cost of capital. This is my estimate that is in the model. This is all before the tax legislation, and you can see, it was already pretty low. It's pretty easy to raise equity and low-cost debt and go out and do whatever you wanted to do. And I don't think lowering it's going to make a bit of very much of a difference. Again, that's in the model. I don't make that distinction. It's not that nonlinear in the model, so we get that effect. But my intuition is that this is really not going to provide as much juice as the models say they're going to produce. And then on the cash side, there is no problem with cash, and you can see that here. This is from the federal. These are from the financial account data, the flow of funds data. Cash is everywhere, and you could argue it's very concentrated, and it is. But if you kind of look, we do look at Moody's. We look pretty much across the non-financial corporate sector. There's a lot of cash. That's not a binding constraint. So I'm pretty skeptical you're going to get a real significant pickup here, and it may happen over the longer run, but I don't think at least in the near future, we're going to get a significant pickup in investment. So bottom line, I think this is. I'll end where I started. I think this is a pretty expensive tax cut for high-income households that doesn't really buy us much growth.